Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 102nd episode. Today, it's time to take a deep dive in the world of global fixed income macro, from debt ceiling to the forthcoming tsunami of Treasury issuance, funding conditions to Fed rates and quantitative tightening. There's a lot to chew on. Our guest is an absolute expert on these issues. Mustafa Chowdhury has held senior positions at several leading firms, including Voya Investments, Deutsche Bank, Stearns and Freddie Mac. He has a wealth of knowledge and expertise on trading, research, and portfolio management of G10 macro rates, mortgage-backed securities, and derivatives. Most recently, Mustafa was the head of rates, FX, and derivatives at Voya Investments, where he was part of a team that managed more than $40 billion in institutional fixed income portfolios. Mustafa Chowdhury, a warm welcome to Kopi Time.
Thanks, Taimur, for having me on your show. And congratulations on more than 100th episode at this point.
Thanks very much. And, we've been talking about having you on for a long, long time. So I'm finally glad that between your busy schedule and travel, you managed to squeeze in some time for us. But I will take full advantage of that, Mustafa. I have lots of questions for you. So let's start with the recently, quote unquote, concluded debt ceiling matter. Looks like we're done for a couple of years. What should we take away from this drama, and what about the eventual resolution that we have right now?
I think the drama ended a lot better than I had anticipated. I was deeply part of or observing 2011 and 2013 drama, and both of those ended with a lot of volatility and anxiety, etc. This time around, it clearly shows some maturity among the key players, and so it ended without too much shock in the market. 2011 was really ugly, with even rating agencies not knowing what to do, downgraded right in the middle of the whole drama. This time, rating agencies away from everything. So I'm very encouraged by the maturity shown by the players. What will happen politically, I don't know. There will be some turmoil probably within individual parties, probably in the Republican Party, but that's a different story.
So you wouldn't say there was any winner or loser. This seems like possibly the best of all worlds, bit of a win-win for everybody.
Well, winner clearly is Biden administration. In the deal, they got a much better deal than initially anticipated, and the Republicans, the GOP, got a worse deal than what they were, significantly worse deal than relative to what they were asking for. And the Biden also got 2 years time, and so it won't come up until after the next coming election. So winner clearly is Biden administration, but as individuals, both Speaker McCarthy and President Biden won for their personal careers.
Indeed. Mustafa, we are having this discussion on the 6th of June. I remember a couple of weeks ago, Janet Yellen saying by the first week of June, the Treasury would be basically out of cash. So even though the deal has worked out, they need to replenish their cash balances. And we're hearing all these astronomical numbers about how they have to issue like $1 trillion worth of Treasury, and it could have some seismically destabilizing impact on the market. What are your views on this?
I don't think it will be destabilizing, but it will be important and probably will provide opportunities for investors. I think that they will probably target replenishing the TGA, the Treasury's account with the Federal Reserve to about $500 billion from near zero at this point. And so $500 billion plus the ongoing funding needs could get to $1 trillion. I think the Treasury will focus more on the short end of the curve, because there is the biggest challenge. Challenge will not be selling the T-bills. I think there will be enough demand for T-bills just because of the higher rates and transition from bank deposits to money market funds. I think the challenge would be not to disturb the bank reserve positions as much, and try to take away from the reverse repo the book of business, the reverse repo funding that the Fed has. So the slight cheapening or some cheapening in T-bills will be healthy, because that will allow money market funds to switch from reverse repo positions within the with the Fed to buying T-bills without Fed having to shrink bank reserves too much. My biggest worry is that the system is not ready to handle large, sudden changes in bank reserves, and we can come to that. This is a whole topic by itself, but it will be cheaper, and and an opportunity probably to buy T-bills.
Would you consider the possibility that $500 billion, which is above the target balance, that they absorb because they need to spend, but they go ahead and spend it immediately, and the cash then just goes back to the economy within a month or two?
Goes back. I'm not totally sure. The TGA I don't know there is anything that was pending or postponed in terms of spending. There were some coupon payments to some trust funds, etc. That was the only extraordinary measure that the Treasury did in the last 5.5 months or so. So I'm not sure that itself will be very stimulative, because the cash will go to the on the asset side of the Fed balance sheet will not increase as well. It will just be a rebalancing. So I'm not seeing a huge stimulus to the economy just from that cash. It's more of a valuation between T-bills and also the reverse repo rates, as well as the banks having enough reserve. That's the biggest question.
Correct. So Mustafa, you said earlier that there is this, need for replenishing the target balances, and then we're going to have this large issuance, which may or may not have a destabilizing impact with the question mark around reserves. But who is going to buy this? Are we talking about non-bank financial institutions with a substantial need for short-term securities, or who else is out there? There's a lot of demand internationally. What's your sense of the investor base that'll pick up this issuance?
I think that will be an increasing challenge to sell treasuries. Right now, the cushion between the HQLA cushion for banks is fairly tight. So we might see banks try to buy more bills and get out of reduce some of the other longer duration assets, etc. Just because a lot of changes are coming in terms of banks managing their balance sheets as well. I also think that investors in general, this is for them to remain more, having a higher weight in cash and using T-bills would be another source of buyers in the bills market. But over a longer horizon, there is a big challenge for buyers for treasuries, whether it's foreign central banks or banking system. The traditional buyers are slowly going to drift away from U.S. treasuries, given the size that's coming, not just this replenishment, but just the fiscal expansion that's expected over the next 2 years, that selling would be a big problem. So in that context, I also think that the QT, they'll have to stop QT fairly soon.
Okay, I was going to ask you a question at the very end of the podcast, and I will ask you that question, but just as an early flavor, so it sounds like you're not particularly bullish the fixed income outlook. I
am more, I'm not particularly bullish at all. in general, in terms of duration, in terms of rates. But within the fixed income, there are areas where there is value. But generally, I think that the Fed will have to come back after they skip in this week's meeting. But they will have to come back and hike quite a bit.
All right. Hold on to that thought. We'll get deeper into that later.
Right.
But before we go in that direction, I just wanted to ask you your overall sense, given this debt ceiling saga and the fact that U.S. fiscal debt GDP ratio is, in triple-digit territory, what would allow for a political consensus toward fiscal consolidation? Or is it just hopeless, regardless of Republicans or Democrats? We will not see meaningful fiscal consolidation in years, if not decades.
Yes. And I think that we will not see any sort of fiscal consolidation in years to come. And there's a lot of there will be increase in borrowing coming from new sources. Some of the trust funds are running out by the end of this decade, so those will have to be run as ongoing entities going forward. So there is a lot more issuance needed. At this
sorry, I just want to interrupt you for 1 second. So by trust funds, you mean Social Security related trust funds?
The Medicare, yes, yeah. Medicare especially is running out sometime within the next 8-9 years. And so the amount of the borrowing that needs to be done just to replenish the trust funds or making it ongoing rather than using trust fund, the borrowing unit will go up a lot. Plus, interest payments is going up also astronomical level. We're touching $1 trillion a year at these high rates. So yes, I don't see any sort of fiscal consolidation coming up or any kind of agreement.
Right. So goes back to your earlier point of not being particularly constructive of fixed income outlook.
Right.
Mustafa, a few months ago, I was visiting you in Washington, D.C., and we were talking about the information content in the yield curve. It's
right.
deeply inverted. It expects lots of cuts within a 12 to 18-month horizon. Is it
right.
necessarily pricing in recession and rate cuts, or there's something else going on with respect to the market structure that we tend to have such steeply inverted yield curve?
I don't think it's maybe a little bit of recession, but I don't think it's reflecting recession or impending recession. Because if you look back a year ago, the curve was equally sort of like a hockey stick shape. It's steep decline for the next 8 quarters and fairly flat after that. And it remained the same shape for last 1 year. So if the yield curve was any predictor of recession would have come already by this time. But there's no sign of recession. And I don't think when it comes, it will be nowhere close to where the yield curve is telling us. I think yield curve reflects mostly markets extremely positioned for the carry that's available. It's unusually large carry from betting against the easing that's priced in the curve. And it's so large that it doesn't allow the curve to move much. So every time Fed hikes, then the market reprices one more hike and then in the curve and not the terminal rate. And then an offsetting ease after that. And that reflects more positioning rather than any kind of recession ahead of us. And I don't think US is anywhere near a recession.
Okay, so the flip side of the lack of information content in the inversion of the yield curve is also the question that what are the inflation expectations market telling us? So when we look at TIPS, the 5+5 implied inflation rate, very well anchored, 2.4%, 2.5%. That doesn't shift, although in the near term, everybody seems to be rather worried about inflation. How do you reconcile these two perspectives coming from the market?
I think the TIPS curve is underpricing the TIPS break-evens, like in the intermediate part of the curve, real rate at 170s sort of range 10 years sort of 160, 150, 160 range. The break evens around between 225-ish to 240-ish. That break even is really low. You can look at many sources to compare why I think it's low. First, Michigan consumer expectation. 1 year forward, 1 year, it's still 4%. And so 4% minus 2.25, you have 175 basis points gap between what consumers are expecting versus what the tips curve is saying. So I think that the real rate is too low at 5 year at 170. And remember also that the Michigan consumers 1 year ahead forecast is actually very reliable. If you look at 2021, when even Chairman Powell was saying transitory, et cetera, the Michigan consumer expectation was actually fairly high. And and that's more of what the consumers are feeling on a day-to-day basis. So my feeling is that the market is somewhat underpricing either future inflation or also underpricing the fact that some sources of inflation are robust and chances of coming back up is very high. And one of them that I'm watching quite closely is rental inflation. So initially the views among economists were that there is a 12-month lag between the real-time rental measures and the shelter component of CPI, right, and it will gradually get incorporated. And so the expectation was that we'll see the shelter component gradually decline, and which has been the case. But if you look at the recent data on rental, whether it's Zillow.com, or if you see the rental REIT, the margins and the profits of rental REITs, the pricing power is very high in the rental, the apartment industry. And also the rent versus buy decision is obvious that rent overwhelms buying because of the mortgage rate and the monthly payment. So rental is coming back, real-time rental is coming back up. So it will be another shock few months down the line that we'll start to see shelter component as CPI, instead of declining as expected, starts to go back up. So all of these are not priced in the tips market. So that's one of the recommendation I'm making our clients is a long-term value of the curve, value of the tips curve is probably good value. Plus this whole question of is this R star, etc., which I'm nervous about opining on that whether R star has gone up a lot and where it is, etc. Right. Is given all the other things that have been changing structurally. Buying tips is probably a good idea.
That's very interesting. So, Mustafa, I have to say that one hand, there is this question whether the R star is going up or not. And then there is this question of this R star, the financial stability related interest rate, whether that the system cannot really absorb the actual R star, it'll collapse long before that. So it seems to me that the market is also sort of betting on that 2% inflation will never happen. Any attempt to get there would create a major financial crisis. So let's just not assume that inflation will stay high or rates will stay high, even if inflation stays high. I'm going to come back to that because I want to ask you two questions on U.S. fiscal and monetary policy. The first one is fiscal, then we'll come back to monetary in a second. So Larry Summers famously, almost 2 years ago, wrote that the Biden administration's repeated fiscal measures were going to be stimulatory, excessively so, and would be inflationary. Now, he had made other nuanced arguments, but that's the argument that has stuck, and he's become sort of extra famous for making that. So are you in his camp that the last couple of stimulus measures on the Biden administration coming into office in 2021 was the sort of the camel's back, if you will, that was broken, and inflation picked up because of that?
Yes, I totally agree with that. I think that that took us to about $6 trillion of fiscal spending. And remember, the student loan forgiveness is still sitting in the court system. and that will add another trillion into the system. So I totally agree with Larry Summers on this point that we actually went pretty far even before the Biden administration in terms of the responses to COVID. But that's sort of hard to judge because no one knew at that time what's the total impact of COVID would be. But in the last couple of years, it's known, and COVID is under control, and we're still spending almost out of control. So I totally agree that the fiscal impulse has been a key driver of the demand side of the inflation equation, at least. And the supply side was already there.
Right. And now we're seeing supply side easing, but the demand side is still not going away.
And unlikely to go away anytime soon.
Right. Okay. But what about the Fed? I mean, do you have any sympathy for the Fed that it's easy for us to look back and say they should have started hiking much earlier, but given the information they had at that time, they probably did the best they could. I'm sort of using the Paul Krugman argument. Do you have any sympathy with that?
Not as much, because I think that I think that the Fed had, or rather, I'd rather say that this Fed, even before all the new dovish members join, is inherently dovish. And so they want always an excuse not to hike. Even now, you see this whole skip versus pause. There's the wording. So there's inherent dovishness in the Fed, and this whole transitory versus permanent and leaning towards transitory, and then suddenly change. Although inflation data was fairly strong throughout 2021, not until November that the chairman first time mentioned something about non-transitory. So I do believe that there was somewhat of a policy error in 2021, and we are paying some price for that.
Earlier, you said that you don't necessarily see a major recession in the horizon. You see rental prices, again, ratcheting up, demand being strong. But we've had substantial policy tightening in the last year, Mustafa. And we saw perhaps a bit of that percolating through the banking system in March and April. Are you worried that there are other areas, there are other fault lines, to borrow a phrase from Raghuram Rajan, that there are other fault lines that are lurking here and there that would cause us some distress going forward?
Within the banking system, there is, I'm not sure, prices. Firstly, in terms of the way the market is positioned, I wanted to mention that before I answer this question. If you look at the market, the Silicon Valley Bank news, when it came out on first week of March, the interest rate, the 2-year rate rallied something like 125 basis points, almost overnight. And then whenever we get a news about hikes, it doesn't sell off. So there is an asymmetry in the market. So the rallies are big if a bad news arrives, but the sell-offs are sort of gradual. It just shows where the vulnerability lies in the market. The bond market is vulnerable to bad news, bad banking news. It's just that bad banking news is not happening. In terms of the strengths, why recession is less likely, and also where the fault lines are coming. The strength is that the market, the Fed, also the economist community, the analyst community, etc., all sort of misread and constantly under predicting it. The payrolls, there's 15 months in a row that the payroll forecasts have been lower than actual realized. So everyone's forecasting a recession, but it's not happening. I think that one of the things that the most ignored has been how strong the households are. And most of that is because of the lock-in effect. that they're locked in at 2.5% to 3% mortgage when the interest rates are close to 7%. That created a lot of implied wealth in the household's balance sheet, even if it doesn't show up in the bank account, and the implied capacity to take risk for the households as well. And so what it really means is that any kind of credit tightening does not seem to affect the households. They seem to be rock solid, feel thin, and I think that whole lock-in effect is way bigger and has not been in anybody's model because there is no data from the past for the lock-in effect. So what it leaves us, so we can't tighten credit for households because they're coming to this hiking cycle so strong and getting stronger. But at the same time, firms are gradually starting to will show weakness. The first, we saw the pricing power and the ability to maintain margin. That's starting to deplete somewhat. And the weak link really is, in my opinion, already started coming from and get bigger, is the small banks to small firms to jobs and then demand, as opposed to past when we had demand directly from tightening credit to consumers. So there is the few steps that will happen, and that's where the main a major weak link, because I'm playing with some data on small banks financial statements for the first quarter, and I see that almost all of them had significant decline in non-interest deposits, and then they have replaced that with higher interest rate bearing deposits or home loan advances, which are full interest rates, etc. So the margin is compressing much faster than the aggregate data shows us. And if you look at the behavior of the small banks in the United States, they tend to lend. They usually don't have securities, and they lend to small businesses that are mostly relationship based. And as the margins compressing for small banks, the small businesses will have the first hit in terms of credit availability from small banks. And we are already seeing that. Some of the survey results for small businesses, NFIB, etc., the credit availability for small businesses are compressing. And the jobs, a large portion of the jobs in the US are actually small firms. And so that's where we'll see the weak link coming. But that's a slower process than in the past. But that I think is a major weakness going forward.
Mustafa, what about the link between banks and commercial real estate?
There is a commercial real estate, as you know, that really vulnerable with the vacancy rate and office properties extremely large. But proportionately, so there will be vulnerability, especially the same banks that are also, the small banks will also be hit with the commercial real estate, but also commercial C&I loans for local small banks. But middle-sized banks will also be hit somewhat with the commercial real estate as they reprice going forward. But they're not, the size of the commercial real estate market is still not big enough to cause a serious systemic risk of the kind that we have seen in 2008 and 9 from residential real estate.
What about non-bank financial institutions? I mean, over the last decade and a half, private equity, venture capital, these entities have played such a big role in fundraising, financing the expansion of the tech cycle, and perhaps even going forward, the industrial policy that is being pursued by the US government. Where do you see those sort of financial models, which are highly leveraged, which tend to be long gestation period? Can they survive this spike in interest rates?
Those are I don't know the survival question, but there is need to study more of those in general in the analyst circle. There's always the question of what does repricing mean in private equity. The whole industry is dependent on the fact that the sector is not mark to market and therefore will survive. So the thing to look for is what are the events that will lead to mark to market for venture capital, for example. And so all of that will depend on the funding as they go for refunding. And every time they go for refunding, there is a mark-to-market event for private equity. So a lot of this, it is, I think that will happen. The refunding will be based on the amount of leverage in that particular industry. And so it may be a little slower, but there is some vulnerability there.
If we are indeed going to have a higher for longer interest rate environment, comment on the international ramifications of that. Every time we have seen an interest rate cycle out of the US, it's caused emerging market distress going back to the 80s. Who's going to get hurt and how bad will be that pain?
I think it's always the emerging market seems to pay a price as the interest rates increase. Take, for example, what I think. So we will have no hikes this week, but in July we will have another hike and maybe one or two more hikes the rest of this year. So we had a little bit of a reprieve in dollar, but we will start to see, and this next 100 basis point of hikes would be a surprise for the market because everyone's thinking, oh, it's already too high. It's the end of the hiking cycle, but suddenly we are heading towards 6.5 in Fed funds rate. And so the dollar will come back into play and hit the emerging markets, I think, fairly hard as if the dollar starts, we are already creeping towards parity with the euro. So I think it's about 105, 106 now. And so that's, I worry about that a lot in terms of the US consumers being so strong, leading to inflation persistent, more hikes than already happened, which would be a complete surprise to both analyst circle and the market, and at the end, emerging markets. And Fed has not absolutely always ignored that part of their policy decision.
So, Mustafa, I share your concern that, yes, of course, interest rate channel is one that will create refinancing risks all around the world. But this dollar channel, in my view, is even more underpriced because everybody that I talk to in the street is basically bearish the dollar. They think the Fed is about to pause, time to go long euro, long yen, etc. If that scenario that you are contemplating, that there are several more hikes left in this cycle, I think it's going to be pretty bad through the exchange rate channel as much as it is through the interest rate channel.
And most interestingly is that it will be bad for everyone else, whether it's emerging markets or even credit products like high yield but U.S. consumers will still be fairly resilient.
Yes,
so which is the interesting part of this whole hike episode.
Yeah, or you could say the unfair part of this whole episode.
Unfair part of it,
indeed.
And one thing I will add is, Taimur, is that I think the path dependency. It's not about what the interest rate level is. It's the path which the interest rate took to get to this point is critical, and everyone's ignored that. And the fact that we remained at this zero rate environment for almost a decade makes a big difference to of this 500 plus basis point than if it was just a V-shaped cut and hike. But zero for many years and then coming back up has changed the structure of different participants in the economy. So the market hasn't been able to capture that. And so constantly underpricing the terminal rate scenario.
No, very, very well put, Mustafa. I think that academics themselves have not spent a lot of time thinking about this. A couple of episodes ago, we had Raghuram Rajan. He is one of those few academics who have been writing fairly consistently about this asymmetry associated with QE versus QT and the various implications can happen through the banking system. You echoed it also very, very well. So yes, I'm with you on that. Okay, here's a final question for you. How would you construct a fixed income portfolio for next year? You've talked about the belly of the tips curve already, but give us a little more.
Yeah, so the portfolio that I have been recommending my clients is that the tips, of course, the belly of the tips curve, potential for, and that's mainly because the Fed might change its target, even if they won't announce it publicly, but just change the target to a higher level. So a good long-term investment. I also think that the U.S. consumer will be very solid. And so mortgage U.S. MBS is a good buy even at this current level. And mainly because of the lock-in effect, American households are not moving around as much as they usually do. And so housing turnover is at its historic low, record low. And just because everyone's so happy with their mortgage, they don't want to move. But eventually, there is a certain minimum amount of relocation that the society has to do. So there's only upside to housing turnover. And at this interest rate, housing turnover is going to be very positive for valuation of U.S. mortgages. I also think that there's some turmoil coming up in terms of valuation in the next few months, with especially how this replenishment of the TGA account and whether the bank reserves will have to fluctuate because of that. And that might create some cheapening in corporate credit products. So I will stay with some cash now at this very high yield and potential for higher rates going forward. And then jump in later in the year, maybe a few months down the line, and probably there will be opportunities in high yield and also opportunities in investment grade, which seems like unusually tight for this environment. If the yield curve was reflecting recession, the spreads don't show it. So
I was just going to ask you, any view on a European fixed income?
I think that they will probably. We have about 2 hikes priced in that. So I still think the US will be a better buy in the tips curve, especially with the higher dollar. Staying with the US will probably be a good idea.
All right, Mustafa, you're giving us views that is not widely shared in the markets, and so we will remember these months.
Great, Timur. We'll catch up again a few months down the line and see if that comes back and hikes.
Oh, it doesn't have to be a couple of months. I'll give you longer than that. We'll revisit this 6 months from now, and we see during the IMF annual meetings. We'll probably take stock. Mustafa Chowdhury, thank you so much for your time and insights. All episodes of Kopi Time are available on YouTube as well as on all major platforms for podcasts, including Apple, Google, and Spotify. As far as our research publications and webinars are concerned, you can find them all by Googling DBS Research Library. Have a great day.